Thank you very much indeed, Andrew, much appreciated. So welcome to the stage, the panel. They say sometimes halfway through the second day at a conference, a session like this is a useful port in a storm, a chance to rest your legs. I'll tell you what, that's not this one. This is an essential port in the storm, and it's not a chance to rest your legs and on your feet, it's a chance to engage your brains. We've got some important stuff to talk about. This morning, or this afternoon session, is going to talk about two of the three drivers behind our amazing industry. Of course, the first is the appetite and the demand from consumers to change. That's always the first driver. The second driver is innovation and technology. And the third driver is regulation. It's those three things that make payments such an extraordinarily brilliant and I think unique industry. We're going to talk about balancing the drive of regulation and innovation. We're going to talk about a whole range of interesting things on that subject, and we have some very highly qualified subject matter experts to share their stuff with you, and so you're very lucky to be in this session. Well done for choosing it. We're going to start by a bit of a scene setter from Rory, but before that I'm just going to remind you that we're going to use Slido for the question. So if you want to ask a question through the next half an hour or so, and we'll be doing about 10 minutes Q&A at the end, then take a little snapshot of that, you'll go to the Slido, and that'll give you a chance to tap in your question. It comes down on these clever gizmos down here, and then we'll choose the questions which we think are going to be most relevant or most challenging potentially for the panelists. So let's kick off. Rory, you're going to set the scene.
Thank you, Tony. Hi, everyone. I think saying that it's a busy road ahead is a bit of an understatement, and that's a good thing for me because I work in policy and therefore it keeps me employed. But I think the challenge is that there is literally so much across government, regulators and industry to consider. Just in the next 12 months, we've got the PSR developing the APP mandatory reimbursement regime, which is coming in October. We have other regulation that is incoming but essentially been parked, such as consumer credit and buy now, pay later regulation. We have the future of open banking, the potential future of open finance, the development of commercial VRPs. We have things such as the DPDI bill, which I'm sure Andrew can talk more about. The Online Safety Act, I could go on and on. I think the challenge is that there is so much, and then from payments professionals, it's important to consider what is important and making sure that we spend enough time on all of those things.
So that's both a lot of interesting stuff, but potentially a lot of noise. How do we start? I mean, let's talk about. Let's pick off some of them, shall we? We're going to start with Betsy. You know, so what's next on the regulation roadmap? To talk to us a little. So Betsy, talk to us a little bit about FSMA and the new Financial Services Act. I'm assuming some people in the audience have a degree of knowledge, but kind of wind back, a bit of basic stuff, and then what this is going to mean.
Sure. So I feel like the ghost of Christmas past because FSMA 2023. You know, it was sort of characterized as being a once-in-a-generational change. It delivered two important things for us. It talked about the revocation of financial services law post-Brexit, so really sort of drew a line under everything that's sort of been pending in the background. Although it will take several years, you know, for the revocation to take place on an SI statutory instrument basis. So it did that, but it also caught up with all the innovation that's happening. So, you know, gosh, where do you even start for payments in there? We had, you know, tons of things going on with APP scams, so keeping up with sort of consumer issues, access to cash, and stable coins. And actually you know, if you think about, you know, one of the, Rory did a fantastic job sort of shaping the portfolio, but we're really conscious about the digital assets regulatory regime. Very complex. You know, we've got central bank digital currency discussions going on. We've got consultations on systemic stablecoins and non-systemic stablecoin rules coming in, and then other types of regulated activities related to non-stable coins. So we've got, like you said, it's even more complex environment. On one hand, just trying to sort of finish the last job with Brexit, and then keep up with other innovation in the market that's happening.
Do you know, I hoped I'd never hear that word again.
Still here.
Still here.
Yeah.
Okay, fair enough. That's very helpful, Betsy, and I think it's also tempting to just think that all this stuff goes on in the background, but some of it's really in the foreground. Andrew, we're going to talk about something that's literally happening right now. Can you update us with what's been going on today and happening tomorrow.
Yes, certainly so, and with very helpful timing. Obviously, John Penrose kicked us off today with his discussion, which was largely predicated on the importance of DPDI, so Data Protection Digital Information Bill, which is going to the Lords committee stage today. I'm quite proud of myself because I had a quick chat with him beforehand, and he's stolen my catchphrase, that it is the one bill to rule them all. Because whether it's the Economic Crime Corporate Transparency Act, whether it's the Online Safety Act, whether it's ISMA, they've all got major data components to them. And obviously as their specific focus in each of those acts, it's how the data is handled, which is the most critically important part, particularly on the fight against financial crime, which has been a constant theme through the 2 days. DPDI is going to set the rules of how we can handle data. It's the most fundamental piece of legislation to knit everything else together so that FISMA, so that ECCT, so that OSA, so they can all actually operate in practice. And again, as from the open banking track from yesterday, the visa track which I was chairing, again a constant theme on the importance of getting all of that data sharing across. And it's just the most important piece of legislation we've seen.
So that's a bit of reassurance. When I hear Rory talk about the volume of different activities and things that are going through, it makes me a bit concerned that maybe does anybody really know what's going on? And what you're saying is you're doing something that's going to bring, or this new bill is going to bring all of this together in a way.
Yes, the bill is going to be knitting everything else together, I was rather hoping I'd be able to make an announcement, but I was just checking email before I came on. I don't have a publication I can announce at the moment, but watch this space, and I will be obviously tagging it back to PAY360, but the one bill to rule them all will be an announcement probably later on this afternoon. Knowing my luck, it'll be coming in whilst I'm speaking. But there will be a major publication coming out later today.
Very exciting. So this theme of this session is about balancing the drive for regulation with innovation. So Matthias, can you talk to us a little bit about some of the things that are really straining the resources of the industry, and why that matters?
Yeah, clearly the roadmap ahead of us is incredible. But what we tend to forget is that a lot of the regulation that has been introduced over the last few years is still very much in play. It hasn't been completed yet. I'm thinking about operational resilience, where clearly the first phases have been delivered, but teams are still working on achieving the 2025 deadline that is near us. Consumer duty, great example, where the first phase has been delivered, but teams are still actively looking at closed products at the moment for delivery at this point in time. So we can't ignore that. A lot of our resources are currently allocated. Many firms out here will not just operate in the UK, they will operate globally, and they will have licenses in Europe. If you take Europe, at this point in time, we're looking at the Digital Operational Resilience Act to be implemented. Just implemented CSOP, the Centralized Electronic System of Payment Information. Very complex from a data perspective, and I think Europe is making good headway on the PSD3 as well. And I think one message to those in government and in regulation roles is that it is important to try and find a form of alignment. I mean, we are drifting away. There's a divergence between the UK and Europe, which adds a lot of complexity, especially in businesses that operate on a single platform with unified processes. And that's the key thing we need to hopefully focus on over the next bits of regulation to come through, to make lives easier, to make it less complex, and to offer better services to our clients.
Can I use the Brexit word twice? Are we allowed to?
Let's use Brexit.
But so the consequence of this was supposedly to allow us to have our own unique regulatory frameworks that would be suitable for our consumers and not affected and influenced by Brussels. That was the idea. But what I think you're implying is that, of course, we actually end up having to satisfy both.
You have to, and I think we have to realize that it's the same set of resources that we draw on. It's our product teams, our tech teams, our regulatory compliance teams that are all managing these processes across the two. And ultimately we want them to focus on innovation to deliver better services, but a lot of it is inbound at the moment. The APP fraud regulation, just to dwell on that a little bit, is a massive impact for businesses like ours. I mean, it's a step change. APIs, EMIs are drawn into this. And I mean, the risk is for smaller firms predominantly, any CEO fraud or any investment scam has a massive impact on their P&L. Smaller firms are at risk of even surviving such a hit. And I think the focus today is to ensure that we don't impact and don't create friction in relation to the onboarding processes, and don't create friction in relation to the speed of processing the payments, not unnecessarily holding payments because we are worried that ultimately it will generate losses or having to result in compensation that we don't want to incur. So there's a lot of that working, and ultimately unifying that again and bringing that under one set of regulations, or at least that it is aligned to an extent that we can work on, will be beneficial.
So you've given the good small companies perspective, and Barry, I'm going to come on to you in just a moment. But before I because to talk about the bank's angle here, but before I do, Rory, can we talk a little bit about the liability shift here? The shift in liability towards firms rather than consumers. Matthias just mentioned the APP fraud. Can you talk to that subject a little bit? Because to me, it's interesting how that is absolutely seemed to have been a direction of travel, and has that gone too far?
I don't think it's gone too far, to put it simply. So yeah, to make clear what the regulation is, the new regime that goes live in October shows that where eligible customers have been a victim of APP fraud, the sending and the receiving firm will reimburse that customer and split the cost 50-50. So the sending firm will reimburse them and take 50%. So that's obviously a big change. There are voluntary measures that are in industry at the moment, the CRM code, for example, and what it is doing is applying a common set of standards for all PSPs within the UK. And I won't go into detail, but there are some little kind of considerations such as a maximum threshold and access, etc. So I think the broad brush is that payments are going to be very different because there's a very different risk profile to all payments now, and I'm sure we can all agree that APP fraud is a horrendous crime, but the challenge is it's very difficult to spot because it's the customer making the transaction. So when looking at £100 to £415,000, there's a massive threshold of payments that we would need to consider and understand, is that a customer making a genuine transaction or is that a potentially fraudulent transaction? Last week, Treasury introduced potential new legislation that's going to go live in October that essentially enables firms to pause payments from about 24 hours to 72 more hours, so moving to about D+4. I think this is broadly good, but I think it's an important thing to discuss today because a lot of PAY360 and all of the firms here are about enabling frictionless payments, and what we are actually doing is enabling firms to add more friction and more delays into the payment process. Now, this is a good thing in the sense that it gives us more time to potentially detect fraud, but what we would argue is that in isolation, arguably not enough. What we would need is more data sharing with other sectors so that we can use that time effectively. So if a fraud starts on a social media platform and then reaches us, all we can see is the transaction. We don't see the Facebook profile that has been made, what the potential fraudster has been saying to the victim. Essentially, we're blind in a lot of areas. What we would like to see, in addition to this legislation, is a move that can be facilitated through the DPDI to have data sharing with other sectors, mainly online platforms and telcos, so that we can use that time effectively, because otherwise we're going to be delaying a lot of payments, causing a lot of customer frustration, ultimately having false positives, which is just a mathematical inevitability.
I completely agree. Data sharing, when that comes up consistently in pretty much every session we've been at on the conference, which is brilliant. And let's hope that that's going to result in more than just words into action. I want to turn to you, Barry, here, because honestly, this is, you're a big global bank. To what extent do you welcome some of these changes in the regulation, and to what extent do you have some concerns about what their impact is on consumer confidence? We're moving from faster payments to slower payments. It's no longer guaranteed that if I want to send you money, that you're going to get it. within 72 hours.
Yeah.
Or at all, maybe.
100%, and I think it's actually interesting. We've looked at this actually in this conversation so far purely from a regulation perspective. If you actually broaden that and look at it from a sort of industry change perspective, it's like there's a whole heap of other major, almost once in a generation change happening on top of that. And I think it's with all these things, it's about balance, right? And it's about making sure we have the right controls and the right protections, but also being able to balance that against the friction conversation. And I think it's exactly that point of, I don't think there's a great answer at either end of the spectrum, right? You can have totally frictionless, high fraud, the challenges we've got there. You can have high friction, back to the 3-day cycle, that we've had, many years ago, we're all desperate to move away from. It's all going to be about how do we, not just as banks, but as a broad industry, actually find the right balance, leverage data to make informed decisions.
I think that balance is interesting. I can see a whole kind of multi-track scenario where certain people whose accounts are run by certain institutions will experience slower payments. So Betsy, pure credit rating, top grade banking facilitation provided by Revolut, I'm sure, or Santander. But if you're dealing with a company that's an EMI, so there could be more friction between certain types of people. So it's almost like, will there be a poor person's bank account and a rich person's bank account? That's a scary thought. Anyway, I'm sure that's not going to happen. Could it ever? But we're going to turn to you now, Betsy, because to me this is interesting. What do we do? We're creaking under this burden of unending regulatory change and duplication and overlap. What are we going to do?
I mean, actually, as somebody who's been in UK markets for 23 years and watched the evolution of the regulator, I always revert back to the better regulation principles. How do we make regulation more efficient? And dare I say, from a firm's point of view. So, if you look at regulatory reporting, for instance, we're now looking at for financial crime. We have a new regulatory relationship with the PSR. We've got APP scam reporting for our customers going to the FCA, and we've got APP scam reporting in regards to any fraud our customers have been the cause of going out to the PSR. I think we need to step back and look at the better regulation principles about efficiency. How do we consolidate regulatory reporting and even supervision, things like that, so that, again, from a firm point of view, if we are going to allow small firms to play in this space, how do we make the regulatory environment more efficient? This came up in the Gartner report. This comes up over and over again, and yet we seem to be heading down the path of making regulation more fragmented with more bodies.
Do you think we have too many regulators, Betsy?
I think their rulemaking mandates are important, and it's not for me to judge, but in terms of how those are implemented for firms, I think we could be much more efficient and streamlined.
I don't think it's efficient to have two organizations regulating payment firms with their own separate payments teams and compliance teams.
And 3 if you're systemic. So if you're systemic, you get booted up to Bank of England, of course. So
Yeah, 4.
like you said, we have quite a fragmented regulatory environment. We all know this, like you said, Gartner report, all the reports before that. So I think, like I said, their rulemaking mandates are important. I really can't speak to that, whether or not that's appropriate. But in terms of how those are implemented, in terms of regulatory reporting, supervision, enforcement, I think those could be more consolidated and more efficient.
So Matthias, let's talk a little bit about this other, I'm being unobjective here, the dark cloud of consumer duty. Because I think for many organizations it's a fog at the very least. It may be even a thunderstorm. Talk to us a bit about that, because how do we get a steer on focusing on consumer outcomes, especially for smaller firms, rather than what we've got at the moment?
I think, as I mentioned before, clearly there's a lot of strain on resources in businesses, and within Equals we're of a size where we have the appropriate resource availability to implement such a complex and intrusive change within the regulation that we have today. Many of the smaller firms do not have that, and this is where I actually want to compliment the FCA and the regulators on launching consumer duty, because the expectations were set really clearly, the phases to run through and the output that was expected actually help business owners and specifically the smaller ones to effectively assess the impact, assess the resource requirement, assess the cost, which ultimately results into better quality, it being properly embedded and integrated within the organization. But it's still hard. And I think this is the area where a regulator and more the supervision side of it needs to step in, because it's still quite undefined on how it's going to be controlled. It's the larger firms that will receive the surveys and have to evidence how you adhere to this new regulation. And we don't see that in the current template that they have. And I think to maintain a level playing field within the industry, we need to ensure that the regulator, the supervisor steps up and finds a way to actually deliver that.
Let's hope that they do. Rory, how is political direction shaping regulation priorities and timelines?
I think it's having a massive impact. I think of 3 immediate examples where stuff has been delayed because it's not a vote winner for the next election. So take us back to 2023 or maybe in 2022. And I can remember the government saying a lot about how they wanted to be the first country to have a crypto asset regulatory regime in the UK. And the original timeline was to have that before an election. I think what we've seen in the last year is the political appetite for that drop considerably. And while stablecoin regulation is being proposed with the FCA at the moment, the phase 2 section of the crypto asset regulatory regime is absolutely not going to be implemented in 2024. And I think the sole reason for that is that Treasury have decided to park it because the risks involved and also because the political appetite. We've also seen with consumer credit and buy now, pay later. I responded to those consultations on behalf of Revolut May last year. Haven't heard anything since. And again, there's a belief that they've been parked until after the election because they're not going to win any votes. The other one is not regulation, but it's looking at the national payments vision. So this is what Treasury announced after the Ghana review, so the Joe Ghana review. Essentially looking at what the future of payments is going to look like in the UK, which I think we all agree is a good thing. The challenge that I see is that they're going to set this out in the summer, but there is an election at the end of the year. It's very much possible that there's a new government that comes in. And so the question that I have, that I'm not sure anyone can answer right now, is if the government sets out a national payments vision in the summer, is that going to be implemented in the longer term? If Labour come in, do they have a different view of what a national payments vision is? Are they going to rip up what the Conservatives have set out? And we see that Labour are very committed to regulation of buy now, pay later, for example, which is a stark contrast to what the Conservative messaging is on payments. So I think it's a big consideration.
I think it's a great thing to raise. I think it is a real risk. It may be a little reassuring to you that all the conversations we have with the shadow representatives, and we are all over that, is broadly that payments is an enabler of growth, and as such, anything that improves our ability to serve society through our industry's competence is a good thing, and that the national payments vision is going to be a supporter of that. So I'm quietly confident, but it's always a risk. So Andrew, let's talk a little bit about, nobody wakes up in the morning and says, I'm a regulator, I'm going to do a bad job or be difficult. They don't do that. They're doing what they're told. So can you talk to us a little bit about how this is a burden on regulators as well?
Well, as you say, regulators don't wake up wanting to do a bad job. They just wake up and want to do a job. But that job is as dictated by the legislation, and this is why the current draft, raft of legislation is so important. And do we have too many regulators? Well, possibly, but do we have enough coordination between the regulators? I think would be a bigger question. Obviously, we have JROC, which is a combination of regulators working together. I think that as we go forward, we'll need to see a JROC Plus, particularly as we've spoken about the need for social media data to be integrated into the banking system. Obviously, the FCA's APP tech sprint 2 years ago now, all the banks thought sharing data between banks isn't actually that important. We need the information from Meta, because 80% of all APP scams originate with a brand new contact on WhatsApp or Facebook.
So 80% of all APP scams
are Meta's fault.
Originate with Facebook marketplaces. Interesting.
Which is
and yet they're not at the table.
And I'll take it quite, because we don't have that. That regulator isn't currently engaged with JROC. So that's where the data sharing piece, we here we're coming back to data sharing. And one of the, I'll pick up a political point for you as well on the Brexit perspective. We have DPDI. Now, we've had the DP bit for ages. That's from GDPR. So that's our transposition. Bad boys, not supposed to transpose the regulation. But that's our version of GDPR. Europe doesn't have a DI. Because once we've got the data, yes, we've got to protect it. Yes, we've got to privacy-enhancing technologies. But, okay, we've got the data. Well, what are we going to do with it? We can do useful things with it. As we keep on saying ad nauseum, we need to share the information responsibly, appropriately, the correct, useful data sets. But that's there, and that's where we're going with DPDI, because the DI bit is, we've had the DP for years. DI is, now we can actually get somewhere with it moving forward.
Okay, very good. Look, I think I've got a few more questions down here, but I like these ones down here. I think these are crackers. So, unprepared panelists, but we're going to ask you anyway, who would like to go with the first one? Because I think got 12 votes. Where has request to pay gone? The global community seems to like the concept, so what needs to change in the pay.uk scheme? Who would like to describe briefly what request to pay is? Would a banker?
Yeah, I'm happy to cover. So I think if I go to the question in terms of request to pay, this is the ability where actually, rather than it sort of being a pull payment like you have with a direct debit where it just comes out of your account, there's a sort of request for you to transfer the money that you then have the control to make a decision on as a consumer. I sort of like a roundabout answer to the question about, why is it not taken off. I think what's really interesting is if you just focus on what we've talked about today. We've talked about the burden of regulation and everything that's going on. We've got the huge industry changes, RTGS renewals, so on and so forth, right? All these things are consuming what is effectively a relatively finite amount of resource. And this is where the conundrum of this panel of how do you balance this against the innovation, and I would put request to pay in that bucket. It is getting squeezed out because of the focus on making sure we do what we need to do. So I think that for me is probably the biggest reason it's not taken off, because there's not the push coming, because there's not enough capacity and resource to focus on it. Yeah,
because I've studied this, and it's almost common sense. Well, why wouldn't you want this? It's like a great idea, and in some countries it's really taken off really well. But you're essentially saying it's been squeezed out by. So that's the cost of us not getting our ducks in a row, our regulatory ducks in a row. Really helpful thing. Any other comments on question one? Anybody like to comment on that? No? Okay, so let's go on to. Oh, I love this one. Does a 415,000 APP, you can read it on the screen there, does it disincentivize consumers from taking proper caution, or does it incentivize them from getting involved with the scam business? Who would like to talk about it? Betsy, you start with this one.
Like most things in policy, you have to have a data-driven answer for this. And I don't actually, people who know me know I run around, with data all day. I actually don't know the answer to this, because it's got to be a data-driven answer, statistical studies. It seems like a common sense answer. If you were to ask me if I'm making a payment online, and I knew that basically there was a victim compensation regime that was going to cover me, I would go for it, probably. On balance, if something was obviously wrong, of course I wouldn't do it. So, but again, we have to have data. Really, looking at these types of questions.
Can you help us at the Payments Association undertake a survey of people who are potential money mule accounts to determine whether they think that they are more likely to be a money mule if they know there's no risk?
An industry survey should be undertaken if it hasn't already.
No, I'm asking you to help. The answer, Betsy just said yes. She just said yes. So I know you will, because you're a great community player. But we literally had that conversation this morning. We're thinking about doing a survey to get some data on this.
This also leads into lots of other questions about whether or not you're incentivizing fraudsters to focus on rich pickings. That's the obvious question. Again, only a financial crime expert, really can somebody who's deeply into financial crime analysis needs to be able to answer that question squarely.
Matthias?
But I was thinking about it, but used to be, if it's too good to be true, you probably shouldn't do it. So think about investment scams offering a ridiculous perspective. People would have been held back, and think about it twice, even on the back of the, let's say, the questions raised through the actual payment process itself. But with this incentive, you kind of take away that sense of let's hold back, do the additional due diligence and go for it, because there's a safety net.
So Andrew, any views, or who would like to comment? Anybody else? Rory? Yep.
I think as with any new regulation and new technology, organised crime will be the first ones to try and exploit it. And unfortunately, it is so blindingly obvious how to just double your money on an ongoing basis, and up to 415,000. That's an awful lot of money for a criminal supply chain to want to exploit and just double up on each occasion, and then vanish into the ether. And I think that's going to take down an awful lot of smaller players, tier ones.
So for those of you in the audience who have been here for the last 2 days, you may not have seen that on Monday, an alliance of 5 trade associations, including the payments industry, sent a letter to the chair of the Treasury Select Committee, Harriet Baldwin, explaining our concerns as an industry about this very matter, and calling on them to have a conversation about the extent to which a proper cost-benefit analysis had been done by the regulator. This is our campaign for the summer, and we hope to be able to get a reduction. My target is to get a reduction in that figure. If not now, then it'll be very, very soon after it gets imposed, when we get to measure the real impact. Great question, thank you. Keep the questions coming. Do we think the UK will follow the EU looking at merging EMI and payment institution constructs? Yeah, great question. What do we think? Who would like to comment on that?
Well, I think they are. I'm genuinely hoping they are. If you look at it today, the definitions of EMIs and APIs here in the UK differ from what you have in Europe. So there's some clarity. So bringing this together will allow for a framework to be much more comprehensive for businesses to continue to support and build a clear definition of what is e-money and the underlying permissions to conduct a business is absolutely required.
Anybody else comment on that? Rory? No? Barry, no, nothing? Okay, good. So crack on with the next one. Thank you. Ooh, digital identity, which comes up in pretty much every session along with the word fraud. So when will stakeholders agree effective digital ID is necessary to secure digital transactions and implement something useful rather than fines after the event? Who would like to have a go?
Well, I suppose I should, as author of the British Standard in Digital Identification and Strong Customer Authentication.
Yes.
So I'm going to say something rather shocking. I don't care about digital ID.
Mm-hmm.
I care about authentication and actually knowing your customer rather than doing tick box compliance for KYC as it currently stands. Because I can get an identity and indeed a digital identity from an EU nation in any name I like. I can prove to you I am Andrew Churchill, Andrew Smith, Andrew Jones and Andrew Brown, because there's no cross-referencing of multimodal biometrics at the moment. When will we see something coming in? It is one of the clauses in DPDI, and I am working with parliamentarians at the moment on, and indeed with Simon Fell, the government's anti-fraud champion, on strengthening the actual technical security requirements which can be put through. Okay. And it will be those standards which I think will be the key.
I mean, I just add, I think whether it's a digital identity, but the authentication piece is so important because especially with the way that technology is going, it's like, your voice used to be this unique fingerprint that no longer is your unique fingerprint. Now it can be copied in 15 seconds and so on and so forth. Mm-hmm. So I think, there's got to be more thought and investment in this space to make sure that we can continue to move at the pace we need to keep things secure. Yeah,
I'm working with the Department of Homeland Security at the moment on deepfakes and adversarial AI. AI is the other thing that you can't go for minutes without someone mentioning AI. AI is just a new term But biometrics are AI systems, and we've been using them for decades. So it's not that new, but the deep fakes are getting better and better and better. But as with all technology, it's an arms race.
And Betsy, to what extent do you think do you think digital identity will actually help?
I love to hear Andrew's comments on this because I've been following along the last couple of months that digital ID is essential to be able to trace for APP scams. So very curious to hear your comments, and I wish we had more time to actually kind of delve into your views. It looks like we're still trying to address fraud on an account by account basis, and my understanding is we need to move to a more identity specific, or else it's whack-a-mole when we close down an account here and then somebody pops up somewhere else. So again, love to have more time to hear your views on what a useful, practical solution would be.
Again, it's the cross-referencing between the acts, and which is that glue behind DPDI, because Online Safety Act obviously has the abuse functionality, so that a Twitter account can be taken down if I start abusing it, but there's no identity behind the Twitter account, so I just open another one and start abusing it, and they shut that one down, and pointless. So that section of Online Safety Act needs to be cross-referenced to economic crime, corporate transparency, the failure to prevent, and DPDI on the identity and authentication mechanisms.
So look, we're gonna run on to the next. We've got 5 minutes or so left. Next, I'm going to do this next one, which is a great one. It's quite popular. Do regulators take their innovation and international competitiveness objectives seriously enough? Why don't I start with you, Barry, again, representing the International Bank, and then Matthias, if you can, and then Rory. I want your views on this.
I think it's really interesting, right? I think, if I'm honest, if you look at regulators, their number one priority is safety, soundness, security of what's there today. It's systemic to market risk and so on. So I think, anyone that thinks there's an equal weighting between these two, I think, I don't agree with that view. I think there's definitely a clear priority around that sort of safety and soundness. I think there is definitely a lot of intent around innovation and, how do we benchmark ourselves, say, in the UK compared to other markets and things like that. But is that transpiring in enough, again, conversation of enough capacity being available in the machine to then execute against those objectives? I think that's the big challenge we'll keep coming back to, is when we've got such a heavy burden of regulatory, industry-driven changes, even the regulators, I think, realise it's very difficult to then put pressure into the ecosystem to enable innovation because everybody's so focused on compliance.
And that's the balance. That comes to the whole essence. I mean, I spoke to one small firm that said that they used to have 8 people in sales and 4 in compliance. They now have 10 in compliance and 2 in sales, and their revenues are falling. I wonder why. Yeah, so there we go. So anything to add to that point, Matthias or Betsy? Anything?
I very much agree with Barry. I mean, the focus is very much on ensuring that we keep in tune with the regulatory requirements, and a lot of investment goes in there, and that has an impact on innovation. And I think I would welcome, and it's topic of many conversations, but to define where we are not competing. If you take FinCrime compliance, we all share the same objective, to keep this out, to keep this safe, and I think it would be great if we can collaborate, and that the regulator will support this, banks will embrace this, and ultimately all firms will tap in and work together to effectively create a safe basis to conduct our business, so we can redeploy all our resources to innovate. And I think that would be the position that we would like to be in.
That's a great aspiration. I love it. Rory, your comment on this?
I think they do. I think it's very easy to moan about the regulators, but actually if you take stock of what's happening at the moment, the FCA is the only country that I know of that is developing stablecoin regulation. PSR is developing consumer VRPs, which I don't know if any other countries are doing. And we're talking about the future of open banking, when most other countries in Europe are still trying to implement open banking. But I think the other side to that is that we should also remember that some of the regulatory objectives are not focused on innovation, they're focused on consumer protection. So consumer duty is one of those, the PSR mandatory reimbursement regime is another. The objective is to improve protections for consumers, not to increase innovation. And so I think it's always worth considering that some of the focus of the regulator is not about improving innovation and competition, it's actually about protecting consumers. And
it's all three though, isn't it? It's all three, and if you do one this is about a balancing act. You can't be protecting consumers at the expense of innovation and competition.
Yeah, true. And like I said, there's innovation that can arise out of that because, if you have increased risk profile of payments, there'll be innovations in how you detect fraudulent transactions, for example. So there is innovation that flows of that, but that is the secondary to protecting the consumer. And I think that that's right because ultimately that is what the regulators are there to do more than to do these other things.
And I really hope that the PSR is right when it predicts that its APP fraud prevention regulation will stimulate more innovation to prevent them happening in the first place. So Betsy, by the way, Kate, this is a really good session. We're going to have another 15 minutes, okay? Because lots of good questions. I'm the producer, conference producer's biggest nightmare. Okay, we've run out of time, but I'm just going to ask you just a very quick word from each of you. A question I've got down here is how can we ensure all voices in the payments industry are heard in these discussions in order to create a holistic approach to regulation that reflects the need to balance? Who would like to? We're going to start down here and we're going to move down here. Literally just a sentence. What's the one thing you'd like to see, Andrew?
I think our biggest challenge there, as we have often seen in the working groups, is that as we are such a diverse community, there are not always consistent views and indeed frequently conflicting views between different members of the association, for example. And that has always been and will always be a challenge of getting there is no single voice as to how should we manage our engagement with the regulator. Because there will always be someone who is an outlier.
Fair?
I would recommend formalizing small firms sort of representation groups. So now the industry association, payments association, some of the other fintech associations are doing a fantastic job of representing the voice of kind of mid-market firms, sort of 10 to 100 employee size firms. But I think we really need to see these firms like my company, Clearbank, we are a service provider to firms of all sizes. But we tend to feel like we need to fight the corner of the smaller firms because they're just not being heard. Their interests aren't really being escalated. So we'd like to formalize the small firm working groups. Associations do a fabulous job. And I actually disagree with some of the panelists. I don't think we're doing enough. We're seeing enough from the regulators on competition. I think we will see more, 2024, 25, as they kind of settle into secondary objectives. We'd like to see more. We'd like to see more analysis of who these smaller firms are, how big of market share they have, et cetera. So we'd like to see more delivery, I think, on competition analysis.
Very good. I love a bit of disagreement on a panel. Very good, Rory.
Financial institutions be the last line of defence against fraud, not the only line of defence. I think that we as a sector need to accept that we should play a role in reimbursing customers because we are ultimately involved in the transactions and the fraud. But to consider putting all of the liability just on the payment sector is not stopping the fraud at source, and so we are going to lead to more reimbursement, not less fraud in the UK. So we need to look at fraud as a holistic thing and not just a financial services issue. And what that ultimately means is bringing in the enablers of the fraud, so the online platforms and the telcos, into sharing the cost of reimbursement. If we accept that you need to incentivize financial services firms to reimburse in order to improve, then you must use that logic at the firms that are enabling the fraud in the first place, and that means a polluter pays policy.
Hear, hear. Hear, hear. Matthias.
I think to Betsy's point, I mean, we should encourage all smaller firms or all firms to participate within the industry forums that are available. Payment Association, UK Finance, AFAP, all representing our industries, and they can have a voice there. They have the back channels into government and to regulators. I think one more practical example is a difference between UK and Belgium approach. So the Belgian regulators actually have informal conversations with their licensed entities, which allows you to more informally discuss the challenges that you have within the line of business, what you recognize, the resource challenges, finding expertise or suppliers, where you can influence the roadmap and be one step ahead. And I think that will help the UK regulators, FCA, in relation to ensuring that we deliver the right things at the right time and focus on the right things as well.
Very nice idea. And finally comment.
I'll just build on that point, which I think it would be lovely to see a little bit more transparency around some of those conversations as they happen, right? So I think there's a lot of dialogue on a sort of bilateral basis. How do we sort of make that more visible to an industry and say, actually, this is what the industry consensus about this regulation, about this issue, about this challenge is? I'd love to see a little bit more visibility back from the regulators about this is how the sentiment in the market is about this.
Can I say that was hugely insightful? I loved it. I hope you all did too. Please, round of applause for our terrific panel. Thank you.